Welcome to Financial Candy. I was just looking at the calendar today, is July 13th, 2026, and flipping through this massive stack of source material you sent over.
There's a lot of ground to cover this time.
Yeah, a ton. And the global markets right now, they just feel like this bizarre split screen movie where the two halves, they don't make any sense together.
They really don't.
Because on one side of the screen, we've got geopolitical shockwaves just rattling the physical supply chain, real panic in the energy sector, physical blockades. But then you look at the other side of the screen, and Wall Street is quietly pulling out the fine china, basically preparing to report record-breaking profits for the second quarter.
Right, and that severe disconnect, that's really the defining economic story we need to map out for you all today.
It's just wild to see it playing out in real time.
Because we are looking at a system where global friction, so whether that is a proposed military toll on a vital shipping lane or, the hidden systemic costs of AI upending the labor market, that friction is generating massive profits for a select few.
While everyone else gets squeezed.
Exactly. Big banks are capitalizing on the chaos, legacy corporations are just buckling under the pressure, and everyday consumers are being forced to find these incredibly creative hacks just to survive it all.
So let's start with that geopolitical friction. And just as a reminder to you listening, we are simply unpacking the market mechanics and the sources here. We're not taking any political stands. But looking at the Trump administration's recent policies, they've reinstated a blockade of Iranian ports, right?
Yes, that's the current reality on the water.
And there's this proposed 20% protection toll on all commercial cargo passing through the Strait of Hormuz, which has, it's essentially set the energy market on fire.
Instantly. The physical reality of that disruption is what the market is pricing in right now.
Because oil jumped over $75 a barrel almost immediately, the Nasdaq sank nearly 1.5%, and that 10-year Treasury yield climbed above 4.6%. It's like mandatory geopolitical surge pricing on the world's most important economic highway.
That's a perfect way to describe it, because regardless of the international legal debate over who controls the strait, the market just reacts to the friction.
And the Strait of Hormuz handles, what, a fifth of the world's oil traffic?
Roughly a fifth, yes. And the UN's International Maritime Organization has stated there's no legal basis for charging mandatory tolls just to transit an international strait.
But the U.S. administration is arguing they deserve reimbursement for guarding the waterway.
Right. So economically, this acts as a sudden, totally unprecedented tax on a massive chunk of global energy trade. Every single vessel passing through has to factor in that 20% premium.
Which alters shipping logistics and costs globally. But wait, I am genuinely confused about how central banks are supposed to handle this, because Fed Governor Christopher Waller just warned about inflation heating up, right?
He did, yes.
And because of this energy shock, the odds of a July rate hike have surged to nearly 47% on the CME.
Which is a huge leap.
Right. A month ago, those odds were sitting at just 8%. So how does the Fed raising interest rates actually help here? Making a home mortgage more expensive in Ohio does not magically clear cargo ships out of a blockade. Aren't they just crushing the consumer twice?
Well, raising interest rates cools down domestic borrowing and spending. But you are entirely correct that it does absolutely nothing to lower the cost of a barrel of oil trapped behind a military tool booth.
It's like they're fighting the wrong war.
That is the core dilemma of monetary policy right now. The global chairman of research at Barclays pointed out that the lack of demand destruction from these elevated energy prices is just exacerbating inflation.
Because people still need gas to get to work.
Exactly. The pass-through of these higher costs is infiltrating everything: manufacturing, shipping, agriculture. When energy costs spike artificially like this, businesses don't stop needing fuel. They just pass that increased production costs directly onto the consumer.
So the central bank is using this incredibly blunt instrument to fight a supply problem.
A supply problem created by geopolitics, yes. And while the Fed struggles with that blunt instrument and the broader indices take a hit, the major U.S. banks are absolutely feasting on this exact volatility.
Right. Looking at JP Morgan, Bank of America, Goldman Sachs, they're in what analysts are calling the financial sector's sweet spot right now.
Because geopolitical unrest creates massive trading volume. Uncertainty forces institutional investors to constantly readjust their portfolios.
So the trading desks are just raking it in on the daily churn. But you were telling me earlier there's this entirely separate engine running in the background for these banks.
Oh, highly lucrative. It's the initial public offering engine. Think about the massive SpaceX IPO that happened recently.
Right. Banks collected hundreds of millions in standard advisory fees for that.
They did, but finance professors note that the real moneymaker for investment banks in these oversubscribed tech debuts isn't actually the banker's fee itself.
Wait, then what is it?
The hidden mechanism generating wealth here involves what the industry calls soft dollars.
Okay, let me stop you there because soft dollars sounds like a backroom handshake that completely locks everyday retail investors out of the process. How does that actually work?
It operates very much like an indirect shadow currency between massive institutions. So when an IPO like SpaceX is massively oversubscribed, everybody wants in at that ground floor price.
Sure, it's guaranteed money if the stock pops.
Exactly. And investment banks have the power to decide who gets those highly coveted shares. So they allocate them to specific hedge funds.
And in return,
In return, those hedge funds direct their everyday standard trading business to the bank's brokerage arm, paying inflated trading commissions. Those are the soft dollars.
so the bank isn't explicitly selling the IPO shares for a cash bribe.
Right, they're trading access for a guaranteed stream of future brokerage fees. It creates this closed-loop ecosystem where the biggest players consolidate wealth and completely freeze out the retail market.
That is wild. But that closed-loop system in the U.S. is actually facing a massive disruption from overseas right now, looking at these international bond yields. Japan seems to be throwing a wrench into the flow of global capital.
A very large wrench, yes.
Because after decades of essentially zero interest rates, Japanese 10-year government bonds have hit levels we haven't seen since 1996. They're nearing 2.9%. What is driving that sudden spike?
Well, Japan essentially abandoned its yield curve control program. To break that down, for years, the Bank of Japan artificially pinned their interest rates down near zero.
And they did that by just constantly printing money and buying their own government bonds, right?
Exactly. They were essentially the world's ATM for cheap money. Global investors would borrow cheaply in Japan and then invest it elsewhere for higher returns.
But now that they've stopped that artificial pinning,
Now, Japanese bonds are offering real returns natively. So for the first time in decades, Japan is acting as a highly investable bond market.
which means all that money is flowing back home.
Right. Japanese investors have repatriated massive amounts of capital recently. They sold off nearly $30 billion of U.S. debt in the first quarter this year alone.
Wow. So that era of Japan acting as the silent subsidizer of cheap global borrowing has just definitively ended.
It's over. And with the traditional bond market flipping upside down like this, you're seeing retail traders hunt for yield in incredibly weird places.
Yeah, I saw that prediction market company Kalshi is launching a pro product where speculators are literally trading on the statistical odds of a Federal Reserve rate hike.
It's pure speculation on monetary policy.
And at the same time, the crypto space is just aggressively pushing into the mainstream. There's the Clarity Act, which is a major piece of cryptocurrency regulation pushed in the Senate to honor the late Lindsey Graham.
And it's gaining significant traction backed by heavy industry lobbying.
Which makes sense when you look at the sheer scale of these alternative financial entities. I mean, it forces us to rethink what a bank even is in 2026.
Take Tether as an example. They're the company behind the world's largest stablecoin.
Right, and according to European Central Bank data, Tether was the single largest buyer of gold last year.
Yes. And they hold over $135 billion in U.S. government debt.
Which is more than the entire sovereign nation of South Korea holds. And they manage this colossal level of capital while employing, what, roughly 200 people?
Just about 200 people, yes.
A company employing 200 people buying physical gold for Swiss nuclear bunkers and holding more U.S. debt than South Korea, that completely erases the line between regulated banking and crypto speculation.
It blurs it beyond recognition.
And looking at the political connections in your sources, and again, keeping this strictly neutral, in the UK, a major shareholder in Tether recently made political donations totaling about $27 million to the Reform Party.
And that coincided directly with periods where the Bank of England was debating crucial stablecoin regulations.
So the intersection of immense capital, alternative finance, and political influence is just rewriting the regulatory rulebook globally. The traditional banking lobby is suddenly competing with alternative entities that have sovereign-level balance sheets.
And that massive concentration of capital doesn't just sit in bank accounts either. It is actively funding the next technological arms race.
Like the billions generated in IPOs like SpaceX being poured directly into artificial intelligence.
Exactly. And the public feud on X between Elon Musk and Sam Altman highlights just how intense this AI arms race has become.
Musk is touting SpaceX's new Grok 4.5 model, and he's suing Apple and OpenAI over alleged anti-competitive practices. And Altman is firing back, launching OpenAI's GPT 5.6 Sol, and they are just trading highly personal insults online.
The billionaire drama makes the headlines, absolutely.
You know, seeing billionaires trade insults online actually makes me appreciate platforms that just focus on human creativity. Like you can always find human-focused financial candy, brain candy, and classic audiobooks over at clarineratio.com. It's just a much better vibe.
A much quieter vibe, for sure.
Definitely. But getting back to the tech workforce, beneath the hype of these new AI models is a really brutal reality. Amazon has laid off more than 57,000 corporate staff since 2022.
Yes, the mandate from leadership there is to operate like a startup and use AI to reduce the corporate headcount.
But the incentive structures this creates inside these companies are just bizarre, specifically this practice called token maxing. Explain that to me.
So token maxing is this unintended consequence of tying employee performance metrics directly to AI adoption. Software engineers began essentially spamming internal AI tools,
Yeah.
right? Consuming as many computational tokens as possible, simply to climb internal leaderboards.
Because they needed to prove to management they were utilizing the new technology to avoid getting laid off.
Exactly. Amazon actually had to shut down an internal ranking system because developers were using the AI with little regard for the actual output. They were generating garbage code purely to gain the productivity metrics.
Let me make sure I understand the absurdity here. AI is supposed to be this ultimate efficiency tool, meant to reduce friction.
In theory, yes.
But it is actually incentivizing engineers to sit there and spam the software just to look busy to an algorithm. We have invented the most advanced technology in human history just to create a high-tech version of shuffling papers on a desk.
It is incredibly counterproductive.
The system isn't boosting productivity at all. It is just shifting the friction onto the workers, forcing them to run a bureaucratic rat race just to justify their employment.
Well, the efficiency gains are entirely theoretical when the human incentive is simply survival. And research from Boston College indicates this AI exposure is actively pushing older workers out of the workforce, specifically those 55 and older.
And the highest exposure isn't in manual labor, right?
No, it's in highly paid white-collar fields. Web development, database architecture, data science. Older professionals in these fields are transitioning out of work or facing unemployment at statistically significant rates since the introduction of these advanced generative models.
And the geographical fallout from these tech and federal job contractions is highly concentrated, too. Looking at the worst performing state economies in the U.S. for 2026, places like Maryland, Rhode Island, and West Virginia are suffering immensely.
Because they rely heavily on those specific sectors.
Right. Maryland experienced the biggest federal job cut of any state in the country, losing around 25,000 federal jobs in a single year, which essentially flatlined their economic growth.
And the economic contraction hitting those regions is not isolated to tech or federal jobs either. Legacy corporations globally are feeling a similar squeeze and being forced into desperate survival strategies.
Like Volkswagen confirming plans to cut up to 100,000 jobs globally?
Yes, they are caught between two distinct pressures right now. Intense competition from Chinese electric vehicle brands in Europe and the restrictive impact of U.S. tariffs on their exports.
And the default instinct for these massive legacy companies is always to try and merge their way out of trouble, just combining their bloat rather than fixing it.
Which brings us to the entertainment industry.
Right. We are watching a proposed $110 billion mega merger between Paramount and Warner Bros. Right now. But 12 states, led by California, have filed a lawsuit to block it.
The core argument there is that combining two of Hollywood's biggest hitmakers would kill competition,
Right.
giving a massive conglomerate the power to enforce monopoly pricing on theater tickets and streaming platforms.
But consumers are actively rejecting those bloated pricing models anyway, which creates an opening for companies operating with, like, intense surgical efficiency. Aldi is the prime example here.
They really are. They recently opened a location hidden in the basement of a luxury Manhattan apartment building.
This detail is amazing. Upstairs, rent starts at nearly $5,000 a month. But downstairs, Aldi is selling a jar of almond butter for $4, while the exact same product costs $22 at premium grocers in the same neighborhood.
It's a massive price difference.
Aldi just operates like this quiet submarine slipping past the massive, heavily armed battleship that is Walmart. I mean, Walmart spends $20 billion a year on automation, AI delivery routes, robotics. Aldi proves you do not need a massive tech budget to win over inflation-weary consumers. You just need extreme, relentless focus on logistics.
And the mechanics of supplying a discount grocery store in a Manhattan basement require a highly specialized logistical symphony.
How do they even get the trucks in there?
Well, because of the city's real estate costs and traffic congestion, Aldi supplies the store using specialized shorter trucks, and they run 3 to 4 trips every single night.
Just to avoid the daytime gridlock.
Exactly. And each truck requires a 2-driver team just to navigate the tight turning radiuses of Manhattan streets. Plus, they keep their overhead incredibly low by relying almost entirely on private label goods rather than premium brands.
So they offer a fraction of the inventory a normal store carries.
Right, about 80% of the inventory a traditional retailer carries, but at a fraction of the cost because they own and optimize the entire supply chain.
And we are seeing other fast casual brands adopt similar targeted expansion strategies to escape stagnant domestic markets. Like Chipotle is opening its first restaurants in Mexico this week, seeking fresh growth.
But the surging popularity of a discount grocer in a luxury basement really highlights a much darker reality for everyday people.
Which is the immense financial strain of simply existing in 2026.
Yes, the data reveals a severe poverty premium that is heavily penalizing low-income households.
Yeah, that study focused on London found that families in deprived areas pay roughly $800 or about 600 British pounds extra every year for basic goods and services compared to wealthier households.
Which is incredibly counterintuitive to a lot of people.
Right. How does having less money mathematically result in paying more for the exact same goods? The systemic design just seems totally backward.
Well, the premium is extracted through structural friction. Lower-income households often cannot pass credit checks for standard monthly utility billing.
So they are forced onto prepay energy meters.
Exactly, which carry much higher per-unit rates. On top of that, their motor insurance rates are inflated based entirely on their postcode.
And lacking reliable transportation, they're forced to shop at more expensive local convenience stores rather than traveling to large, cheaper supermarkets like an Aldi.
Right, and community safety nets are just buckling under the weight of this prolonged cost of living crisis. For example, a baby bank in Bedford, which provides essentials like formula, clothing, and cots, saw demand nearly double, supporting over 2,000 families in 2025.
That's heartbreaking. And the charity noted they are increasingly seeing repeat referrals from working parents who simply cannot make wages pace with basic household costs.
And the financial friction increases exponentially for unbanked and vulnerable populations. Addressing the policy notes in your sources, and again, maintaining strict neutrality on the administration's goals here, the Trump administration recently issued guidance urging federal bank regulators to heavily scrutinize lending to immigrants without work authorization.
Basically officially reminding banks of their duties to manage the risks of lending to these individuals.
Yes, and consumer advocates warn this will have a chilling effect, pushing vulnerable consumers outside the regulated banking system and into riskier, unregulated financial shadows like payday lenders.
Because systemic design currently defaults to penalizing the people with the least amount of liquidity. If you pay a bill late, you get hit with a fee. If you cannot afford direct debit, your energy rates are higher. It is incredibly frustrating to read through.
It is.
But your sources also highlight some market mechanisms actively being designed to help consumers fight back and find some leverage.
Right. Automated switching services are fundamentally changing how consumers interact with utility and financial providers.
By completely removing the friction of cancellation.
Exactly. In the UK, the communications regulator Ofcom launched one-touch switch rules. Previously, telecom companies would deliberately put customers on hold or hang up to prevent them from canceling contracts.
We've all been there, stuck on hold for an hour just trying to cancel internet.
It was a business model. But under the new rules, consumers only have to contact their new provider, and the software automatically handles the cancellation and transfer behind the scenes.
And the banking sector has a similar tool called the Current Account Switch Service. Banks will actually pay you cash incentives to move your primary account to them.
And the service does all the heavy lifting.
Right. The automated service transfers your balance, redirects your salary, moves all your direct debits, and closes the old account within 7 days. It is a rare instance of the system actually working to protect the consumer's time and wallet, removing the nightmare of having to negotiate with a frustrating provider.
So looking at the macro picture of all these sources today, we're clearly operating in a deeply divided dual economy.
That's the split screen we talked about at the start.
Exactly. Capital, data, and wealth move at light speed for Wall Street traders, capitalizing on volatility. Crypto whales holding billions in sovereign debt, and tech giants restructuring around artificial intelligence.
But incredible physical and financial friction defines the reality for everyone else. Whether it is a geopolitical toll booth in the Strait of Hormuz, the logistical symphony required to deliver affordable groceries to a Manhattan basement, or the poverty premium extracted through a prepay meter in London.
It leaves us with a vital question to consider as these systems continue to evolve. Because the grand promise of technology and artificial intelligence over the last decade was that it would create a frictionless, cheaper, highly connected global village.
So if the technology is finally here, why are the most profitable ventures right now, from military straight tolls to investment bank trading fees to employees spamming AI tokens just to keep their jobs, why are they all entirely reliant on adding new layers of friction to the system?
Something to chew on until next time.